A very important week this week. We do have FOMC on Wednesday, and remember, the Fed is supposedly supposed to reduce this to 25 basis points versus the other times when we had a lot higher. Since data is supporting things are going the way that they want it to go, so they're starting to become softer and softer with that. However, I would argue a lot of that already is priced in, as we've seen with this short covering rally as of now. As you guys know, I am bearish for the mid to long term, and so far it's been a short-term bull trend as we've continued up so far, and we did break the key trend line that started at all-time highs that I've referenced in the past is the one that has had hard rejections on the past year, end of March, as well as middle of August in this bear market. And we did break above that. So a lot of people getting very excited for continuous upside or potential continuous upside because of just this trend line break so far. However, I would argue that still the mid to long term seems very bearish to me. Again, we still have yet to see a hard impact on earnings, at least from what the Fed has been doing over the course of the last year. We haven't seen that much of an impact on earnings yet, and that is something that has a lagging effect historically. So I am watching for something like that. Yes, again, the trend has been short-term bullish. However, personally, I'm using this as a time period to accumulate long-term puts, as well as also dabbling in some SPXS. That is a triple leverage bear ETF. So SPXL is a triple leverage ETF for the S&P 500. Allows you basically to have triple the leverage, hence the name, on the S&P 500. The inverse would be the SPXS, which basically benefits on the market falling. So right now, I'm just starting to accumulate those downside bets with a lot of time on my side. A lot of people, especially in the trading community, especially for retail, like to take these bets that are very short in terms of expiration, especially like zero data expiration contracts. You have to remember at the end of the day, when you're dealing with stuff like zero data expiration contracts, it is a lot closer to a casino than these longer term expirations. And that's by design. You have to remember the market maker makes money off of this spread. The more that you fail, the more the market maker is going to make money at the end of the day. So by design, when you see zero data expiration contracts, especially those that are out the money, there's a reason those contracts are cheap. That is because they are less probable to end up hitting. You are betting against probability when you take those contracts, and unless you have a very strict risk regimen in place when you're trading them over the course of a long period of time, you will end up failing. So you need to make sure that you understand this, and you still could trade zero data expiration. Again, it could be something that's very profitable. You just have to make sure that you have a system in place, which unfortunately not a lot of people have a system in place. And therefore, I would argue it's better off that you take more longer term approach like I'm doing right now by adding longer term shorts in terms of options and also that triple leverage bear ETF. So that's currently where my mindset is right now. Yes, we've continued a lot higher than maybe I even expected. I would see before I referenced a rejection off of this downward trend line as potentially being a top of this rally from back here. We did have an initial rejection, but it continued a lot higher after retesting the previous channel that you can see over here. This is a resistance from the previous channel. We had a perfect retest on the daily chart here, and then it bounced straight off and continued a lot higher even after retesting the downward trend line from all-time highs, and we've continued so far. We did have a weekly close above the key trend line, which shows bullishness, at least in the short term. Again, I still am bearish for that mid to long-term thesis, but as of now, it seems to just delay that thesis just a little bit longer. Again, nothing too worrisome at the moment, and I am fairly confident that this is just another short squeeze rally or bear market rally that is, as we've seen in the past, just like the one in August, just like the one in the end of March, early April. This seems to be the exact same setup, and I will treat it the same way I did both of the other bear market rallies by accumulating shorts. Again, very difficult to time the exact top. These are very hard to do, especially with how many shorts have to cover on the way up, especially because a lot of this is fueled by beaten down tech. We've seen with Tesla, for example, this thing has just been squeezing and squeezing and squeezing, just taking a lot of the shorts out that were short during the entirety of this big downward move from back here. We are now reaching a key supply range. This is a pretty wide supply range. However, it still will act as a resistance. And if you're a Tesla bull, I would be very, very careful around this range that we have right here. This also happens to be close to the neckline around this 205, 207 range, neckline of the major head and shoulders pattern that Tesla formed over the past couple years so far. So do be careful as we continue into this range over the course of the next couple weeks, because this could be a prime rejection spot for at least weakness that will aid in overall market weakness that can aid to that downward move that I'm suspecting in the next couple months. Along with that, there's been no shortage of short-term Tesla bulls as of lately. You can see just based on the float, this is only from Friday. We tweeted on the Twitter account on Friday. It looked a lot like 2020 again in terms of Tesla flow. This is what it was literally every single day of 2020 for Tesla, just a ton of bullish bullish flow, especially a lot of these were pretty close in expiration. You can see like the 203s, 303, 127 for the 0-day expiration on that day, 317s, just a lot of close expiration. And what's interesting in this flow is a very similar occurrence to what we've been seeing in SPY is a lot of these are short-term expirations for the most part, with the bearish bets in terms of puts being more long-term. You can see here this $2.3 million put for the 175 strike was for a 119 of 2024. You can see over here 721 for 2023. And again, a lot of these puts, especially throughout this past week and also Friday, are 2024 or a lot further into this year of 2023. It's been characteristically the case, as we've seen from this past week, that a lot of these bearish bets are with time. And that's the key concept here. The short term seems bullish in terms of the flow, yet the long term and mid to long term, same thing with SPY, seems that is more characteristically bearish. So we have to make sure we understand that, because just because there is a lot of upside in the current time period does not mean that has to remain as a constant as we continue forward here in the next couple months. And people just need to understand that perspective. You can trade with a bullish bias on Tesla, especially when flow like this is coming in, hitting the tape, especially with a short-term expiration. You could trade based on that in terms of the short term, but realize that the long term seems to be more characteristically bearish, and you need to watch out for that in the future. Also, something important to note with that, the fact we've seen a lot of strength with tech lately in terms of just a rebound. Again, it's just a form of a dead cat bounce, a lot of shorts getting squeezed out because tech has been very bearish over the past year, especially. It's been one of the most bearish indexes. On the opposite end of that, the Dow Jones has been one of the most bullish indexes throughout this bear market, yet the Dow Jones has had a difficulty catching a bid in comparison to the S&P 500 as well as the NASDAQ in this past time frame. What that means is the Dow Jones is starting to get weaker, and this is one of the first indexes that should show weakness if we are to start another downward trend, or a downward trend to be established here in the future. And what's interesting here is, again, we have yet to get past the highs that we've made of this rally yet. The S&P 500 and NASDAQ have been shooting way past the highs that they made previously throughout their own bear market rallies, respectively. So what that means is once this starts to really establish more so of a downward trend and it retests this downward trend line that started at all-time highs. Remember, we have these lines on each of the major indexes throughout this bear market. They've respected these downward trend lines. Once we have a retest of this downward trend line or around this area, we should be able to reevaluate price action and figure out if it's ready to break back below. If the Dow Jones breaks back below this trend line, which I suspect it will at some point during this year, the first half specifically, that will tell us that there is the start of a new downward trend. Dow Jones would most likely lead that, because it led the past major rally. It was the strongest index of this past major rally. So a break below this level, and I'll actually draw the line right around here to make sure that it stays stuck to this top over here on August 16th. But a break below this level will establish a new downward trend for not only the Dow, but also the weakness will resume on the SPX as well as the NASDAQ after this occurs. Another key concept here, and this is something that has to start to catch a bid if there is to be that downward trend that I'm expecting in the future, is the dollar. You can see here the dollar was within this pennant, and this should, keyword should, be a bottoming pennant, because we've seen a lot of pennants in the past around this downward range, whether it be in tech like we saw before or the S&P 500. We've seen a lot of these pennants on tech related stocks, for example, be the bottom before a major rally upwards. So I would assume there would be a similar characteristic here on the dollar, which if the dollar were to catch a bid and continue upward, which as of now, it's just retested its own pennant and it's bounced off of that. There hasn't been that much action in terms of the end of the day of Friday, but we'll see as we go into this week if there's continuation. If there is to be continuation, that would lead to more downside and weakness in the S&P 500. So this is something that you definitely should watch for, because this will make a move earlier in the week, and this is something that can give a lot of insight on where the S&P 500 and just the market in general can go in the near term especially. And lastly, just to summarize the flow that we saw on Friday for SPY, the last two prints, at least if you filter for above 1 million in premium on Cheddar Flow, the last two prints are a very telltale sign for what I expect for this year. Again, going back into that Tesla scenario, we have a big short-term call here for SPY for 6.6 million in premium, about 28,000 contracts on this, and this is for a 415 strike, so it is quite a bit out the money for this 210 expiration. So February 10th, very close in expiration. If you look one above, you could see a 17.7 million in premium, 385 strike. This is a lot of premium. Very rare to see this on a SPY print, let alone a SPY print that is quite a bit out the money, and this one has a lot more time. This one has about a year of time. This is for January 19th of 2024, and this basically summarizes at least my thesis for this year, with the short term being relatively bullish as it is now. Again, difficult to time the exact top, so this person believes that there's potential for further upside in terms of the short term, but with the other person coming in and hitting the tape here for the 17.7 million, this whale suspects that there will be more downside in the future and may not be able to time the exact top of the market, at least for this rally, but they suspect that they still will be profitable at some point in the year, so they added a lot more time on their contracts. And this is basically what I am doing myself right now, using this time to accumulate those shorts that have a lot of extra time, maybe even trade here and there in terms of the short term with a short term bias on those trades. And overall, just use this as a time to be patient, load up, and just let the market do its own thing. So other than that though, appreciate you guys watching this video. We'll see how this week goes. Will be exciting with FOMC, and we'll see you guys on Twitter as well as the Discord, which the links are both below if you are interested in following us on Twitter or joining the Discord. A lot of activity in there lately, and we will see you guys in the video on Wednesday.